Breaking the Gateway, Why Starship Flight 13 is SpaceX's True Commercial Turning Point. Introduction, One Engine Ignition, for Consequential Outcomes. On July 31, 2026, a rocket will attempt to light its engines in the vacuum of space above the Indian Ocean. If it succeeds, that single ignition, lasting seconds, sets in motion a chain of commercial, financial, and geopolitical consequences that reach from Boca Chica to Wall Street to the lunar surface. This article examines why. Section 1 breaks down what Flight 13 is actually testing, and corrects the widespread misconception that this is an orbital mission. It is not. It is a carefully scoped suborbital re-examination of two specific failures from Flight 12, a booster that could not complete its boost-back burn, and a ship that could not demonstrate an in-space engine relight. Both must be resolved before Starship can do anything commercially useful. Section 2 covers what a successful Flight 13 looks like in practice, a double splashdown, not a tower catch, and why that conservative approach is the right call given where the program stands. Section 3 is where the commercial stakes come into focus. It covers the V2 to V3 satellite capacity leap that only Starship can unlock, the cost per kilogram economics that reshape every launch market simultaneously, and the $14 billion plus in confirmed government and commercial contracts that are technically gated behind Flight 13's engine relight. Contracts that have nothing to do with Starlink V3 and nothing to do with the FAA's V3 regulatory pipeline. Section 4 addresses what all of this means for SPCX's $2 trillion valuation, including 3 scenario-based projections, the mechanical forces of NASDAQ 100 inclusion and staggered lockup expiries, and an honest assessment of the AI compute contracts that have transformed SpaceX's revenue narrative since IPO while carrying 90-day termination clauses that investors must understand before pricing them as permanent infrastructure revenue. The through line across all 4 sections is the same: Flight 13 is not the finish line. It is the first gate. But it is the gate everything else depends on. 1. What is being tested, the core objectives. Flight 12 in May 2026 marked the debut of the new Starship V3 vehicle architecture and demonstrated meaningful progress on atmospheric re-entry, but it left behind 2 unresolved technical milestones that define Flight 13's mission, 1.1.3, 1.1.4. Flight 13, consisting of Booster 20 and Ship 40, is fundamentally an engineering re-examination designed to conquer the core operational bottlenecks that Flight 12 could not clear, 1.2.3, 1.2.5. The in-space engine relight validation. During Flight 12's ascent, one of Ship 39's 6 Raptor engines shut down after approximately 36 seconds, 1.1.2. While the vehicle's remaining engines compensated to achieve its planned path, the subsequent planned in-space relight demonstration was aborted as a result of that earlier anomaly, 1.1.3. Flight 13 must successfully execute a relight of its Raptor Vacuum, RVac, engines in space, something that has not yet been demonstrated on any Starship mission, 1.2.5. Doing so proves Starship can actively manage its trajectory beyond the ascent phase and execute a controlled, on-demand deorbit burn, the foundational capability for any orbital mission. Raptor 3 booster reliability. Flight 12 also saw a serious booster anomaly. During the boost-back burn after stage separation, engines across the outer ring failed to reignite properly, causing an early boost-back shutdown, 1.1.2. The booster subsequently attempted a landing burn but only a single engine ignited, resulting in a high-speed hard splashdown in the Gulf of Mexico, 1.1.3. Flight 13 will stress-test the modified Raptor 3 architecture, featuring a redesigned zero external tubing layout, to demonstrate that it can reliably cycle on and off in rapid succession across all flight phases without the ignition anomalies that ended Flight 12's booster recovery, 1.1.2. The suborbital repeat profile. Given Flight 12's dual anomalies, the Flight 13 mission profile has been modified to a repeat suborbital flight, mirroring Flight 12's intended trajectory rather than attempting a true orbital insertion, 1.2.5. The primary objectives, engine relight and booster recovery, do not require orbital altitude to be validated. A successful suborbital relight demonstration on Flight 13 would clear the technical prerequisite for a true orbital attempt on Flight 14 or beyond. 1.2.5. 2. What is expected, the dual recovery safe play. Flight 13 will prioritize gathering structural and telemetry data over attempting a tower catch. 1.1.2, 1.2.5. Following a safety philosophy requiring consecutive precise ocean landings before returning a vehicle to a land-based tower, Flight 13 is widely expected to attempt a double soft splashdown. 1.2.3. The booster will aim for a controlled soft splashdown in the Gulf of Mexico, the same recovery zone Flight 12's booster was targeting before its boost-back anomaly. A clean booster splashdown on Flight 13 would be the first time a V3 Super Heavy has successfully completed its full post-separation flight profile. 1.1.4. The ship will follow its suborbital arc to a targeted ocean splashdown, gathering telemetry on the upgraded Raptor 3 engines, heat shield performance, and, critically, the in-space engine relight that Flight 12 was unable to attempt. 1.1.4. A clean execution on both objectives clears the remaining FAA mishap investigation milestones. 1.1.1, and sets up a potential tower catch attempt as early as Flight 14 or 15. 1.2.3, 1.2.5. Elon Musk has stated that a Starship upper stage catch is probably Flight 13 to 15. 1.2.7, though Flight 13 is expected to prioritize data collection over that milestone. 3. The structural impact, from engineering to capital markets. Turning the Starlink V3 profit spigot. The scale of what's at stake becomes clear when you compare what SpaceX has now versus what Flight 13 unlocks, and why one does not simply replace the other. Falcon 9 is not standing still. As of June 2026, SpaceX is on pace for approximately 140 to 145 Falcon 9 launches this year, having already launched its 1,000th individual Starlink satellite of 2026 by January 2, 20. Each mission currently deploys 24 to 29 V2 mini-optimized satellites, each carrying improved phased array antennas and more capable radios than the original V1 constellation, meaningfully increasing total network bandwidth with every flight, not just geographic coverage. January 2, 21. The constellation now exceeds 10,400 operational satellites in orbit, and Falcon 9's reusability economics, with individual boosters completing 25 to 35 missions each, are what make this relentless cadence financially sustainable. January 2, 20. But Falcon 9 is approaching a hard ceiling on what it can deliver. The binding constraint is no longer booster availability. With roughly 20 active boosters capable of a 9-day turnaround, the fleet could theoretically support far more launches per year. The true bottleneck is upper stage production and payload processing throughput. January 2, 22. More fundamentally, no amount of Falcon 9 launches can ever put a V3 satellite into orbit. The satellites are physically too heavy, each V2 mini weighs under 600 kilograms, while the incoming V3 satellites weigh as much as 2,000 kilograms each, more than 3 times heavier, exceeding Falcon 9's payload capacity entirely. 1.2.8. SpaceX has been explicit about this dependency in its IPO prospectus. Our current operational rockets, including Falcon 9 and Falcon Heavy, are not capable of deploying V3 satellites and V2 mobile satellites. January 2, 10, Starship is the only vehicle capable of lifting them. Critically, Starship's development and test cadence does not compete with or delay Falcon 9 operations. SpaceX has deliberately separated the two programs onto entirely independent pad infrastructure, consolidating all Falcon 9 and Dragon missions at SLC-40 at Cape Canaveral, while transitioning LC-39A at Kennedy Space Center exclusively to Starship and Falcon Heavy operations. January 2, 23. Flight 13 itself launches from Pad 2 at Starbase, Texas, geographically and operationally independent of every active Falcon 9 pad. SpaceX's longer-term plan adds SLC-37 as a second Florida Starship site, with FAA approval already granted for up to 44 launches per year from LC-39A and 76 from SLC-37, January 2, 24, a total of up to 120 additional Starship launches annually from Florida alone, entirely alongside Falcon 9's existing cadence rather than replacing it. The two programs are not in competition for the same infrastructure, they are parallel revenue engines being built on separate tracks. The performance gap between V2 and V3 is not incremental. Each V3 satellite delivers 1000 gigabits per second of download and 200 gigabits per second of upload bandwidth, better than 10 times the capacity of a V2 Mini, 1.2.8. Multiply that across a full Starship payload bay and the arithmetic becomes stark. SpaceX has stated that each Starship V3 launch will add 60 terabits per second of downlink capacity to the Starlink network, more than 20 times the capacity added by a single V2 Mini Falcon 9 launch, 1.2.8. To put that in investor terms, SpaceX's internal cost for a reused Falcon 9 Starlink mission runs an estimated $15 to $30 million, January 2, 11. To match the 60 Tbps of network capacity a single Starship V3 mission delivers, SpaceX would need to fly more than 20 equivalent Falcon 9 missions, representing $300 to $600 million in estimated internal launch costs. Against that baseline, even a conservative internal Starship cost estimate of $30 million per flight implies a per unit capacity cost reduction of 90% or more, January 2, 12. Starship's first confirmed external customer price, $90 million, per Voyager Technologies' SEC filing, suggests the commercial list price sits well below that Falcon 9 equivalent cost stack regardless, January 2, 13. The implication for SpaceX's corporate profitability is direct and significant. Starlink is already the company's sole profitable segment, generating $4.4 billion in operating profit on $11.4 billion in revenue in 2025, a 39% operating margin, January 2, 14. But that profit is currently being consumed and then some by Starship development costs, which ran to $3 billion in 2025 alone, leaving SpaceX with a GAAP net loss of $4.9 billion for the year, January 2, 15. In the words of one via Satellite Analyst Roundtable, the space and connectivity segments are quite healthy and profitable, it is the Starship development program itself that is the drag, January 2, 16. Once Starship reaches operational status and begins flying V3 deployment missions, that $3 billion annual development cost burden transitions from pure expenditure toward revenue-generating infrastructure. Analysts project Starlink reaching 17 million subscribers by end of 2026 and 50 million by 2028, January 2, 16, potentially generating $40 billion annually at that scale, January 2, 17. At Starlink's current 39% operating margin, that implies roughly $15 to $16 billion in annual segment operating profit, more than 3 times its 2025 level. The critical variable is whether Starship can bring cost per terabit down fast enough to serve the densely populated urban markets that V3 is designed to unlock, because as analysts at Via Satellite note, without Starship enabling a further reduction in launch costs beyond Falcon 9, the Starlink infrastructure margins will face structural pressure, as subscriber growth pushes into lower income and higher density markets, January 2, 16. Starship as a commercial launch platform, the broader revenue case. Starlink is not the only market Starship unlocks. Once operational, it reshapes the economics of every category of payload currently flying on Falcon 9, and opens entirely new ones that Falcon 9's economics make impossible. Cost per kilogram, the fundamental shift. Falcon 9 currently delivers payload to LEO at approximately $2,700 per kilogram at list price, or an estimated $1,500 per kilogram in reusable configuration. Starship, at its 150-ton LEO payload target and full reusability, is projected by analysts to reach $500/kg in the near to medium term, a reduction of 80 to 95%, January 2, 18. Elon Musk's long-term internal target is $10 per kilogram, which most analysts treat as aspirational, but even the conservative $100-200/kg range represents a structural repricing of access to orbit, January 2, 19. At $90 million per flight and 150 tons of payload, Starship already delivers to orbit at $600 per kilogram, below Falcon 9's reusable list price per kilogram at a fraction of the flight count, January 2, 13. International commercial satellites. Falcon 9 currently commands roughly 82% of the global commercial launch market share, 1.3.1. With Starship, SpaceX will be able to offer international satellite operators, including those building large GEO communication satellites, LEO broadband constellations, and Earth observation fleets, a vehicle that can deploy multiple satellites per flight at a fraction of current per kilogram pricing. SpaceX's VP of Commercial Sales confirmed at Satellite 2026 in March that the Falcon 9 manifest is packed through 2028 to 2029, with payload processing throughput rather than rocket production now the binding constraint, a signal that pent-up commercial demand is waiting directly behind Starship certification. 1.3.2. DoD and national security launches. SpaceX already holds approximately $22 billion in cumulative federal contracts spanning NASA, the Space Force, the NRO, and the Space Development Agency. 1.3.3. Starship's operational certification unlocks an entirely new tier of this market, with the Pentagon's confirmed and near-confirmed Starship-dependent pipeline now measured in billions per program. The commercial market waiting behind Starship. Beyond existing customers, Starship's cost curve enables entirely new market categories that cannot close their business cases at Falcon 9 pricing: orbital data centers, in-space manufacturing, large commercial space stations, and lunar cargo delivery. A substantial volume of commercial contracts is effectively on hold, waiting for Starship certification before committing. 1.3.2. Analysts project the total addressable market for Starship-enabled services at approximately $150 billion. 1.3.6. Why Flight 13 unlocks two separate revenue tracks, not one. It is important to separate two distinct commercial pipelines that Flight 13 affects, because they operate on very different timelines and face very different gate conditions. The first pipeline, Starlink V3 deployment, carries the most gates. Before SpaceX can fly production V3 satellites, it must close the FAA's Flight 12 mishap investigation. Any anomaly on Flight 13 resets that clock. 1.1.1, finalize FCC approval for the expanded V3 constellation. 1.2.9, and allow the two Dodger Dog prototype satellites deployed on Flight 12 to complete their in-orbit validation of real-world thermal and radiation performance before manufacturing locks. 1.2.9. Flight 13 itself is designated suborbital, meaning true orbital demonstration moves to Flight 14 at the earliest. 1.2.5. Taking these dependencies together, the earliest credible V3 deployment window remains Q4 2026 at the optimistic end of SpaceX's own second half of 2026 guidance, with early 2027 the more likely outcome if any single gate slips. January 2, 10. The second pipeline is structurally different and moves faster. A successful engine relight on Flight 13 satisfies the primary technical prerequisite for Starship to begin flying any orbital commercial payload, regardless of the V3 specific regulatory and manufacturing gates. This pipeline already has confirmed, paying customers with collectively billions of dollars in contracted revenue on the manifest. Starlab Space Station, $90 million, confirmed, SEC filed. Voyager Technologies' 10K SEC filing confirms a $90 million fixed contract with SpaceX to launch the Starlab commercial space station on Starship, no earlier than 2028, January 2, 13. This is a fixed commercial deal with a publicly traded company required to disclose it in SEC filings, real commercial accountability, not a letter of intent. Starlab must reach orbit before the ISS is decommissioned, creating a hard deadline that makes Starship certification timeline a direct program risk for a multi-billion-dollar NASA-backed infrastructure project. 1.3.4. Astrolab Flex Lunar Rover, $160 million customer payload manifest, confirmed, Business Wire. Astrolab has signed 8 enterprise customers to fly payloads on its Flex rover Mission 1, with those contracts collectively valued at more than $160 million, 1.3.7. SpaceX will transport the Flex rover to the lunar surface using its Starship launch and landing system, marking SpaceX's first confirmed commercial lunar cargo delivery contract. The customer base spans water extraction technology, lunar construction infrastructure, biological research, and data archiving, 1.3.7. DoD national security contracts, $6.45 billion confirmed, Space Force, Pentagon. SpaceX has secured a $4.16 billion Pentagon contract to build missile tracking satellites for the Golden Dome defense architecture, on top of a separate $2.29 billion firm fixed-price agreement with the Space Force for the Space Data Network backbone, finalized May 26, 2026, requiring a fully operational prototype by December 31, 2027, 1.3.8. As the Starship program scales, heavier national security payloads and next-generation Starshield satellite batches become natural candidates for transition to the larger vehicle, multiplying per-flight revenue at Starship's economics rather than Falcon 9's, 1.3.3. NASA Artemis HLS, $2.9 billion, confirmed NASA contract. NASA awarded SpaceX $2.9 billion for the Starship Human Landing System contract covering Artemis 3 and 4, 1.3.4. Each crewed Artemis mission requires between 4 and 14 Starship tanker flights for orbital refueling before the lander departs for the Moon, 1.3.5, at $90 million per commercial flight. That represents $360 million to $1.26 billion in launch revenue per Artemis mission for the tanker flights alone. The in-space engine relight Flight 13 must demonstrate is the direct technical precursor to the propellant transfer capability this architecture requires, 1.3.5. Taken together, Starlab, Astrolab, Golden Dome, SDN Backbone, NSSL Phase 3, and Artemis HLS, the confirmed Starship commercial and government manifest represents over $14 billion in contracted or near-contracted revenue. None of it requires FCC approval for V3 Starlink. None of it waits on Dodger Dog telemetry. All of it waits on exactly what Flight 13 is designed to prove. 4. What Flight 13 means for SPCX valuation. SpaceX's IPO on June 12, 2026, the largest in history, raising $75 billion at $135 per share, priced the company at approximately $1.77 trillion at listing, 1.4.1. After a 19% surge on day one, the stock briefly pushed the market cap above $2 trillion before pulling back, 1.4.2. From its intraday peak of $225.64 on June 16, SPCX has already declined 31% in 4 trading sessions, erasing approximately $620 billion in market cap, before any engineering outcome on Flight 13, January 4, 13. As of late June 2026, SPCX trades around $153, 1.4.5. The valuation carries a substantial forward premium. At its post-IPO peak, SpaceX was trading at roughly 115 times trailing sales, the highest price-to-sales ratio of any major public company, more than double Palantir's 59x, 1.4.3. Future Search's sum of the parts model puts fair value near $1.25 trillion, with Morningstar's discounted cash flow model landing lower at approximately $780 billion, 1.4.4, meaning the current market price embeds between $750 billion and $1.25 trillion of pure future optionality across 3 distinct segments: Starship commercial operations, Starlink V3 deployment, and an AI compute infrastructure business that has been fundamentally transformed since IPO pricing, but which carries structural conditionality that must be understood before any valuation floor is drawn around it. Near-term structural forces. 2 mechanical forces will shape SPCX's price trajectory regardless of engineering outcomes. First, SpaceX joins the NASDAQ 100 on July 7, triggering approximately $8 billion in forced passive buying within the first month of inclusion per BNP Paribas estimates, a near-term demand catalyst, 1.4.5. Second, lockup expiries are staggered rather than a single event. The first wave hits in August 2026, coinciding directly with the August 6 earnings report, making August the single highest risk month on the calendar for SPCX holders, with a much larger secondary wave following in December, January 4, 13. SpaceX's first earnings release is confirmed for August 6, 2026, for trading days after Flight 13's net launch date, making the flight's outcome directly material to how management frames commercial guidance on that call, and landing precisely at the moment the first lockup wave breaks, 1.4.9. The XAI compute revenue base, meaningful but structurally conditional. The AI compute contracts represent the most significant shift in SpaceX's revenue narrative since the IPO, but they carry termination risk that must be understood before any valuation floor is drawn around them. Anthropic agreed to pay $1.25 billion per month through May 2029 for the entire output of Colossus 1, more than 220,000 NVIDIA GPUs, in a deal valued at approximately $45 billion over its full term, January 4, 11. Google separately agreed to pay $920 million per month from October 2026 through June 2029 for access to approximately 110,000 NVIDIA GPUs at Colossus 2, January 4, 14. Reflection AI then signed a $150 million per month agreement beginning July 1, 2026, adding approximately $6.3 billion in committed compute revenue if it runs to term, January 4, 11. Combined, the AI compute run rate approaches $2.3 billion per month, a figure that already exceeds Starlink's entire 2025 monthly revenue, January 4, 13. However, all three contracts include 90-day termination clauses, exercisable after initial lock-in periods, meaning the headline totals of $45 billion, $30 billion, and $6.3 billion are maximum term figures, not guaranteed revenue, January 4, 16. The Google deal carries an additional delivery risk. If SpaceX fails to deliver the committed GPUs by September 30, 2026, Google may immediately terminate or accept fewer GPUs at reduced fees, and retains a general exit right with 90 days notice after December 31, 2026, January 4, 14. Critically, a Google Cloud spokesperson described the arrangement as a short-term, timely agreement to ensure we have bridge capacity for its Gemini Enterprise Agent platform, language that suggests Google views this as a temporary gap filler rather than a long-term infrastructure commitment, January 4, 12. All three contracts were disclosed in SpaceX's S-1 filings within 3 weeks of IPO pricing, a sequence that sophisticated investors should note when assessing the durability of the AI segment's revenue base, January 4, 12. The honest framing is this: the AI compute contracts provide meaningful near-term revenue visibility and change the character of SpaceX's income statement for at least the next 2 to 3 quarters. But they do not constitute a permanent valuation floor. The floor they establish is better described as a rolling quarterly floor, renewable at each party's discretion, and investors pricing the AI segment as permanent recurring infrastructure revenue are making an assumption the contract terms do not support. 3 valuation scenarios post-Flight 13. Bear case: Flight 13 fails or is partial, valuation, $1.5 to $2.0 trillion. A second consecutive anomaly resets the FAA mishap investigation clock, delays V3 deployment into 2027, and deflates the Starship optionality premium that sits at the core of the current valuation. The first lockup wave breaking in August, coinciding with the earnings report, creates immediate supply pressure without offsetting commercial revenue catalysts from the space segment. The AI compute contracts provide near-term revenue support through at least Q1 2027 before the earliest practical termination dates, but the bridge capacity framing from Google and the 90-day exit clauses mean the AI floor is softer than the headline $80 billion total implies. Historical precedent is sobering. the 15 largest U.S. IPOs since 2006 averaged a 50% drawdown during year one and finished an average of 33% below their IPO price, which would imply a price around $90 at some point in the next 12 months if SpaceX follows the pattern. January 4, 13. A Flight 13 failure scenario risks testing the $135 IPO price floor, with the valuation range settling at approximately $1.5 to $2.0 trillion, the lower bound reflecting AI contract attrition risk on top of Starship delay, the upper bound anchored by Starlink's $4.4 billion annual operating profit. January 4, 10. Base case: Flight 13 succeeds, Flight 14 begins commercial operations Q4 2026, valuation, $2.5 to $3.0 trillion. Engine relight proven, FAA investigation closes cleanly, first international commercial payloads fly before year-end. Market beats consensus price target has already moved to $212.67, reflecting analyst updates post-reflection deal, January 4, 15. The August 6 earnings call is the critical fundamental anchor. Underwriting banks including Goldman Sachs, Morgan Stanley, and JP Morgan come off their quiet period simultaneously with that release, potentially expanding active analyst coverage from 6 to 15 or 20 analysts, mechanically shifting the institutional consensus, 1.4.8. In this scenario, SpaceX walks into that call with a proven engine relight, a confirmed commercial launch timeline, and $2.3 billion per month in AI compute revenue flowing through initial lock-in periods. The first lockup wave supply pressure is partially absorbed by Nasdaq 100 passive inflows and improving fundamental visibility across all three segments, with the AI contract termination risk partially offset by the logic that counterparties are less likely to exit when SpaceX's overall trajectory is visibly strengthening. 1.4.5. Bull case: Flight 13 succeeds, V3 deployment begins Q4 2026, AI segment approaches break-even, valuation, $4.0 to $6.0 trillion by end of 2027. Arete Research's Andrew Beal retains the highest price target on Wall Street at $401, implying a $5.3 trillion valuation, resting his thesis on Starlink V3 scaling via Starship and subscriber growth holding near its 50% annual pace, 1.4.7. In this scenario, Starlink V3 deployment adds 60 Tbps of network capacity per Starship launch, AI compute contracts renew beyond their initial periods demonstrating stickier than feared demand, and SpaceX's $60 billion acquisition of Cursor, Anysphere, begins generating enterprise AI coding revenue, January 4, 16. Simply Wall St forecasts SPCX reaching GAAP profitability within 3 years, January 4, 16, the threshold that unlocks S&P 500 inclusion and the largest potential passive demand wall available to the stock. At the upper bound of a post-S&P inclusion scenario with all three revenue engines confirmed, some models push towards $6 trillion by 2028, though this figure is analytically derived rather than the published target of any single analyst. The Flight 13/August 6 earnings nexus. The two events are separated by 4 trading days and are analytically inseparable. A successful Flight 13 on July 31 gives SpaceX management the ability to walk into the August 6 earnings call with a proven engine relight, a confirmed suborbital success, and a credible Q4 2026 commercial launch timeline, converting over $14 billion in contracted backlog from speculative pipeline to active delivery schedule, and providing the strongest possible context for AI compute counterparties to renew rather than exit. As one analyst framed it, Starship commercializing is the biggest variance in the entire bull case. If Starship reaches operational scale, it reduces launch costs by an order of magnitude and unlocks orbital cargo, tourism, and eventually deep space missions as real revenue lines. 1.4.8. The first lockup wave breaking in August, regardless of engineering outcomes, introduces immediate float expansion at a moment when the stock's near-term trajectory will be shaped almost entirely by whether Flight 13 has succeeded or failed 4 days earlier. The 90-day AI contract termination clauses introduce recurring renewal risk that does not exist in the Starlink or Starship revenue lines. And S&P 500 inclusion remains blocked until GAAP profitability is achieved, a threshold no single quarter of Starship success crosses on its own. Success on July 31 shifts the probability distribution across all three segments simultaneously, giving the stock its best possible footing heading into the most structurally dangerous month on its calendar. Failure collapses the Starship premium, raises AI contract attrition risk, and sends the stock into the August lockup wave without a fundamental anchor, a combination that could make Morningstar's $780 billion fair value estimate look less like a floor and more like a destination. Conclusion: what to watch for on July 31. Flight 13 is carrying four distinct burdens simultaneously, and investors, engineers, and policy watchers are each tracking different ones. For the engineering community, the two binary outcomes are clear: does the Raptor Vacuum engine relight in space, and does Booster 20 complete a controlled splashdown without a repeat of Flight 12's boost-back anomaly? Either result produces data. A success produces a green light. A failure produces another investigation cycle and a reset of the FAA mishap clock. For the commercial launch market, the question is whether Flight 13 success translates into a credible Flight 14 commercial manifest. The $14 billion plus in confirmed contracts, Starlab, Astrolab, Golden Dome, SDN Backbone, Artemis HLS, do not require V3 Starlink deployment, FCC approval, or Dodger Dog telemetry. They require a proven engine relight. Flight 13 is the key. For Starlink specifically, the path is longer. V3 deployment remains gated by the FAA investigation, FCC approval, and Dodger Dog in-orbit validation, a chain that makes Q4 2026 the optimistic end of SpaceX's own second half of 2026 guidance and early 2027 the more probable outcome if any single gate slips. For SPCX investors, three numbers define the next 6 months: August 6, when the first earnings call lands 4 trading days after Flight 13's net date, underwriting bank quiet periods expire simultaneously, and the first lockup wave begins introducing new supply, the secondary lockup wave in December, which floods the market with significantly more float, and the GAAP profitability threshold, currently the single largest barrier to S&P 500 inclusion and the passive demand wall it would trigger. The AI compute contracts, Anthropic, Google, Reflection AI, add $2.3 billion per month in near-term revenue visibility, but their 90-day termination clauses mean they soften the bear case rather than eliminate it. They are a cushion, not a floor. What ties all of this together is a single undemonstrated technical capability, an in-space engine relight that SpaceX has never successfully executed. Every commercial contract, every deployment timeline, every valuation scenario in this article converges on that moment above the Indian Ocean on July 31. The current $2 trillion valuation does not reflect a market that has confidently priced in Flight 13 success. If it had, the analyst spread would be narrow, not the $164 per share gap between Morningstar's $62 bear anchor and Oppenheimer's $310 bull case. Instead, the current price reflects a probability-weighted blend across a genuinely wide range of outcomes, sitting closer to the $135 IPO floor than to the upper end of that range. That is precisely what makes Flight 13 the swing event. A successful engine relight resolves the uncertainty favorably, pulling the distribution toward the $2.5 to $3 trillion base case and beyond. A second consecutive anomaly resolves it unfavorably, pulling the distribution down toward the $1.5 to $2 trillion bear case at exactly the wrong moment. The first lockup wave hits in August 2026, coinciding with the August 6 earnings report, making August the single highest risk month on the calendar for SPCX holders, January 4, 13. Against a stock that has already shown it can erase $620 billion in market cap in 4 trading sessions without any engineering failure, January 4, 13, and against a historical backdrop where the 15 largest U.S. IPOs since 2006 averaged a 50% drawdown during year 1, January 4, 13, the asymmetry is clear. Failure has more room to hurt than success has room to help, simply because the bear case sits much further from the current price than the base case does. The rocket either lights, or it doesn't. The market has not yet decided which outcome to believe, and July 31st is when it finds out. 1.2.1 References and sources.